future.
Look, if anyone tells you that, never believe them. They're probably just trying to sell you one of those courses for $997. So even though there's no magic ball that can tell you when to buy a stock before it rockets in value and makes you a millionaire overnight, there is certainly a few things I do to tip the odds in my favour, and that's what I'd like to share with you guys today. As I've got older and slightly greyer, I've found that knowing the reasons behind why a stock might change in price has helped me make and save a lot of money. If you're new to the stock market, then a stock is a small part of a company, and when you buy it, you actually become a part owner. The idea is to buy parts of a company that you believe will go up in value, so you're able to multiply your money without doing any extra work. But let's face it, investing in the stock market can be pretty confusing, and most people just pick companies on a whim. However, that's not how I do it. So by the end of this video, you'll know my actual strategies for picking great stocks. And don't worry, I won't be trying to sell you anything, so you can just sit back and relax. So there are two main ways to attempt to predict the stock market. These are called technical and fundamental analysis. A good way to think about this is like a scale. Usually short-term day traders are purely focused on technical aspects. These include looking at charts and patterns. They believe that they can predict how the stock will change in price by judging the highs and the lows on the graphs. They're the geeky ones. Nah, I'm only kidding. It's just not how I do it. My whole investment strategy is about keeping it simple. Lots of people talk about using margin and options, but that's really not something I worry about. I'm a long-term investor, so this means I'm a lot more focused on the fundamentals of a company. This includes the financials, the leadership and the brand recognition, as I believe this is where the information lies to indicate the long-term success of a stock. However, like I mentioned, it's a scale, so I do cast my eye over the occasional chart in order to find the best time to buy. This approach has helped me to find some really good investments over the years, rather than just dipping in and out and trying to make a profit on a daily basis. The amazing thing is the majority of professional traders are still unable to beat a low-cost index fund over the long term. This may sound quite complicated, but it's actually very simple. So this bucket represents an individual stock, and the water is me pumping all of my money into that company. This represents an index fund, each cup being a different company, and the water I'm putting in is the money I'm spreading between each of them in one easy investment. For whatever reason, if this company goes bankrupt, then guess what? All my money goes down the drain. Now this is the same company and it still goes bankrupt. But the good thing is I may lose my money in that small investment. However, I've got so many more stocks and I've done really well in some of them, which means I've actually made a profit overall. My favourite index funds track the S&P 500, which are the top 500 public companies in the USA. So even though the majority of my money goes into index fund investing, I also have a lot of fun picking individual stocks and watching my portfolio grow. On this note, if you'd like an easy way to get started, Public are currently giving away a free stock worth all the way up to $50 when you fund your account. If you want to pick that up, I'll leave a link in the description. And if you're in the UK, Free Trade are giving away a free stock that could be worth up to £200 when you deposit as little as £2. I'll leave that link below as well. It's a great way to get started with individual stocks, and basically it's free money. Right, so now you got your free stock and you're ready to invest into some more, but where should you start? Well, if you're anything like me, it makes sense to start with the numbers. We call this quantitative analysis. Whenever I'm thinking about investing in a company, I make sure to look at all these figures first. If the financials don't look good to me, then it's very rare that I'll do any further research into the company. It's kind of like when you go on a first date with someone and they seem really nice. However, it isn't until you really start getting to know all the details about them that you might start to notice their flaws, like eating with their mouth open or picking their nose. If only they gave you a non-biased, comprehensive list of how they actually are, so you can make an educated decision whether you want to date them or not. I don't have a solution to this problem, but luckily that's exactly what companies do. It's brilliant. You can find out this information for free on Yahoo Finance, which is the website that I use. There are three main aspects that I look at. First, let's break down the balance sheet. I know it doesn't sound too interesting, but trust me, this is where you find some of the real juicy information. The whole purpose of this sheet is in the name, to balance assets and liabilities. Think of it a bit like this. You may own a watch or a rental property, and these are your assets, But let's say you have loads of credit card debt. This is one of your liabilities. So let's break down some of the gobbledygook terms so you can easily understand this complicated looking sheet and impress your friends. Assets are broken down into 3 categories. Current assets are things that can be turned into cash within 12 months. Longer term assets are things like their headquarters, which they usually don't sell in a hurry. Companies can also have assets that you can't physically touch, known as non-tangible assets, such as the brand recognition of an established business that has been trusted for generations. I like to think of Coca-Cola. And then we come to the liabilities. And what I'm really interested in here are the current liabilities, as this is the debt that they'll need to repay within 12 months. With this, there is a simple calculation you can do to easily know if the company is high risk or not, and that is total current assets divided by total current liabilities. A good rule of thumb here is the number should be above 1. But how does this work in practice? Let's take Apple's balance sheet for example. Apple's total current assets divided by their total current liability comes to 1.4 when rounded up. This is great, as now we know that Apple are able to pay off all their short-term debt nearly 1.5 times. The second document that's really important to have a look at is the income statement. If you've ever heard the saying of the top and bottom line, this is where it comes from. At the top of the statement, this is the total revenue, which is the total the business take, and at the bottom is the net income, which is the money the company makes after all the expenses have been deducted. Every business has these expenses: the cost of operation and the cost of revenue. So let's take a simple business like a smoothie company. Their cost of revenue is fruit. They can't make the smoothies without buying that. Therefore, that is a cost they have no choice about. It's a simple fact of running their business. But the next thing they do have a choice about, which is their operating expenses, who they're hiring and what kind of wages that they're paying them. After these expenses are deducted from the total amount of money they take from their customers, you get the operating income. So here's my simple calculation that lets me know if the business is healthy. Operating income divided by total revenue times 100. Ideally, I look for above 15%. Using Apple again, let's take this number, divide it by this number, and we get 27%, which is great. The last one of the big 3 is the statement of cash flow. I'm not going to spend too much time on this one, as when you boil it down, it's pretty simple. The main thing I look out for is if the company I'm investing in has increasing free cash flow year on year, which is money they can use to reinvest or pay back to investors. A big red flag here is sometimes I see the cash flow is negative, but the company is still paying dividends back to its investors. It's just unsustainable, and eventually the business is just going to run out of cash. Now, once I've had a good look at all these numbers, it's time to get into the juicy stuff, and that's all about analysing the qualities of a company. This is known as qualitative analysis. One of the qualities I look for is brand recognition. When I say the word Apple, most people think about the company rather than the fruit. I know I keep referring to it, but it's a great example of amazing brand recognition that won't be going away anytime soon. Being a household brand name comes with a lot of consumer trust, so when they launch a new product, people are much more likely to try it out, especially if it's something unique or groundbreaking, such as the iPad.
And we'd like to show it to you today for the first time. And we call it the iPad.
This helps companies like Apple shape. Here is in a frenzy, and everyone is asking the same question. Should I sell now before it gets worse? But there's more to this than meets the eye. If you followed me for a while, you know I'm a serious investor who's obsessed with the stock market. And since so many of you have started investing because of my videos, I feel a responsibility to give you my honest take on the situation. So before you panic, let's take a step back and look at the bigger picture together. Every market crash has a cause, and this one isn't random. There are 3 main triggers behind it, and all of them tie back to one man, Donald Trump. Now, before anyone jumps to conclusions, this isn't about politics. I'm not here to take sides, and as a British investor looking in, my only concern is how this impacts investors like you and me. So let's break down the 3 biggest triggers behind this crash, why they matter, and what you can do to benefit from all this mayhem. Trigger 1 is Trump's trade war. Trump has always pitched himself as the ultimate deal maker. He's the guy who fights for American jobs and plays hardball with other countries. But the trade wars he's fighting could increase your weekly shopping bill and cause a recession. The last time the US tried this, it helped trigger the Great Depression, wiping out jobs and wrecking the economy. Now, history might be repeating itself. Stocks are already crashing, prices are rising, and if this spirals, it won't just hurt Wall Street, it'll hit you where it matters most, your bank account. Let me take you back to 1930, when I was just a boy. The US government decided to slap massive taxes called tariffs on imported goods to protect American businesses from foreign competition. It was called the Smoot-Hawley Tariff Act, and it turned out to be one of the worst economic mistakes in history. At first, it seemed like it would help. American companies wouldn't have to compete with cheap imports and more products would be made in the USA. But there was a big problem. Other countries fought back. Nations that used to trade with the US started raising their own tariffs, making it harder for American businesses to sell products overseas. Trade slowed to an absolute crawl. Businesses collapsed and millions lost their jobs. Instead of fixing the economy, it helped turn a regular recession into the Great Depression, one of the worst financial crises ever. Fast forward nearly a century and Trump has brought back tariffs in a big way. In February 2025, Trump announced a 10% tariff on Canadian energy imports and a 25% tariff on other Canadian goods. In retaliation, Canada imposed a 25% tariff on American imports. Then in March, Ontario implemented a 25% surcharge on electricity exports to the US, affecting states like New York, Michigan and Minnesota. However, in my opinion, this was more of a symbolic move that wouldn't have seriously damaged the US economy. However, Trump didn't hold back, and instead of just brushing it off, he fired back by increasing tariffs on Canadian steel and aluminium to 50%. Unlike Canada's move, this wasn't just for show. It hit Canada's manufacturing industry hard while also driving up steel prices for American businesses that rely on imports. But why am I telling you all this? Well, this is where the real problem starts. Tariffs sound good on paper, as they're meant to punish foreign businesses while encouraging more stuff to be made in America. But in reality, they end up hurting regular people more than anyone else. As a business owner who manufactures products and imports from China myself, I know that when businesses are forced to pay more for materials, they don't just absorb the cost, they pass it on to their customers. That means higher prices on cars, appliances and electronics. In addition to this, food becomes more expensive because supply chains get disrupted, meaning that everyday essentials cost more, stretching household budgets even further. On top of that, other countries aren't just sitting around while Trump raises tariffs, they're forming new alliances to trade without the US. China is leading the charge with the BRICS alliance, partnering with Brazil, Russia, India and South Africa to reduce dependence on American trade. So the more the US isolates itself, the more other countries look elsewhere for business. So what's my opinion on all of this as an experienced investor? Well, if Trump goes all in on this trade war, history suggests it'll do more harm than good. While some industries might get a short-term boost, the long-term damage, such as higher prices, weaker global ties, and a slowing US economy, could far outweigh any benefits. But if I'm being completely honest, I don't think Trump actually wants high tariffs. I know that sounds crazy, but hear me out. Trump is, at his core, a businessman and a deal maker, just like me. That's why I believe he's using tariffs as a negotiation tactic, not as an end goal. So if that's true, what does he actually want? Well, I think he's after free global trade, but on terms that favour the US. And if he pulls that off, it could pay off big time. However, the problem is his approach is creating massive uncertainty. The constant backtracking, new tariffs and mixed signals are spooking the stock market because investors hate unpredictability. If this drags on too long, it could shake confidence so much that it pushes the economy towards recession, something even Trump's own administration has admitted they're willing to risk. Right now, the market isn't just reacting to tariffs. It's reacting to uncertainty about what comes next. And in investing, uncertainty is one of the biggest killers of confidence. Trigger 2 is Trump's stance on NATO. Trump has openly questioned the role of NATO, the military alliance that protects Western countries. He suggested that the US shouldn't keep defending allies unless they start paying more for their own protection. While that might sound like a fair demand, if the US steps back from its NATO commitments, it could create a power vacuum that countries like Russia and China might exploit. Markets hate uncertainty. The second investors sense that world stability is at risk, they panic. If NATO weakens, it could encourage Russia to push further into Europe, or even lead to new conflicts as countries try to adjust to a world without the USA acting as the global police force. More conflicts mean higher military spending, unpredictable trade relationships, and spikes in energy prices, all of which can rattle the stock market. Trigger 3 is Trump's secret plan. There's been a theory circulating that Trump may be crashing the stock market on purpose. I know that sounds crazy, but there is some evidence for it. Trump has never been a fan of high interest rates. In fact, he's called them ridiculous and has openly attacked the Federal Reserve for keeping them high. Now, here's where it gets interesting. The Fed is technically independent, meaning Trump can't just tell them to cut interest rates, but their decisions are based on economic conditions. If the stock market crashes and a recession seems inevitable, the Fed has no choice but to step in and slash interest rates to prevent a total meltdown. But why does Trump want lower rates? Well, because high interest rates slow down the economy. Businesses borrow less, stocks struggle, people stop spending as much, and for Trump, who loves growth and hates anything that makes America look weak, they're a problem. It's not just about making the stock market go up, it's way bigger than that. The US government is drowning in $36.5 trillion of debt, and when interest rates are high, the cost of that debt goes through the roof. Think of it like a massive credit card bill. Imagine you owe $36,500 and your credit card company charges 10% interest per year. That means before you even start paying down the actual debt, you're being charged $3,650 every single year just in interest. Now imagine the credit card company suddenly slashes the interest rate to 3%. Instead of paying $3,650 per year, your interest drops to just $1,095 annually. That's a saving of $2,555 every single year. Now you can put this money towards actually paying off your debt instead of just keeping up with your interest payments. Well, that's exactly what Trump might be doing, but on a $36.5 trillion scale. If the Fed lowers interest rates, multiple shops and warehouses, then almost overnight, the internet made it irrelevant. I had two choices: give up or adapt. You know me, I wasn't about to quit, so I threw myself into learning everything about making money online. And like most people today, I fell for the hype. I tried every method out there, and guess what? None of them were as easy as people said. But through trial and error, I cracked the code and rebuilt my businesses, but this time with the internet at the core of my strategy. Fast forward to today, and making money online isn't just important, it's an essential thing everyone should be doing. That's exactly why I'm making this video. I spent years testing, failing and refining, losing millions, making millions, and learning what actually works. Now with this knowledge, I can help you avoid all the mistakes and fast track your success. So if you're tired of false promises and ready to commit for the next 6 to 12 months and build something real, this is for you. No gimmicks, no BS, just the process that actually works. All right, so this is the online wealth wheel. And whether you realize it or not, you're already on it. There are three main stages that define where people are in their journey to making money online, plus a secret fourth stage that only a few ever reach. We'll discuss that one at the end. Let's kick things off with stage one. This is where everyone starts with no side hustle. And sadly, 55% of people never start at all. Inflation is making everything more expensive. And let's be real, relying on a single paycheck is more dangerous than ever. So if having a side hustle is essential, why do 55% of people still avoid it? Because the online space is a jungle. It's full of ads pushing proven methods that confuse more people than they actually help. The key to starting the right way is picking a method that suits your skills, budget and lifestyle. If you already have a skill like video editing, graphic design, coding, or even setting up Discord servers, people pay great money for these services and there's no shortage of demand. But what if you don't have a skill to sell, or quite simply don't want to deal with clients? That's where product-based businesses come in. One of the best options is selling products online without ever holding inventory yourself. But I'll get into this in more detail later on. That brings me on to running a failing side hustle. I'm classing a failing side hustle as earning less than $50 per month online. Sadly, 28% of people are trapped here. A lot of people aren't going to like me saying this, but it has to be said. It's almost never your side hustle that's flawed or doesn't work. You're most likely just not putting enough time and effort in. I know that can be hard to hear, but this isn't really your fault. It's down to something called shiny object syndrome. This is when you constantly jump from one trendy online money-making method to another without committing and putting your absolute all into any of them. One week it's drop shipping, then print on demand, then selling books on Amazon KDP, then trading stocks, and then starting a social media agency. The truth is, all the online money-making methods I just mentioned work, but each requires a different level of time commitment, and you'll never get anywhere by jumping from one to the other. It's like that classic diagram of miners tirelessly digging for gold, only to give up just before striking it rich. Instead of pushing through, they abandon their progress, start fresh somewhere else, and waste all that initial effort repeating the cycle over and over again. If you get stuck in this dangerous pattern like the 28% of other people, then you need to recognize it and simply pick a method and stick to it. Forget the idea of a perfect side hustle. Just pick one that's easy to start and has the potential to scale. If you don't have a high income skill to sell, then I'm going to make this super simple for you. In all my years of experience, the thing that has made me the most amount of money online is e-commerce. So I recommend you focus on that, but not in the way most people do. A lot of beginners assume starting an online store means dealing with inventory, suppliers, or complex setups, but that's not the case anymore. That's because you can now utilize AI-built Shopify stores. Instead of spending weeks setting everything up like I had to back in the day, you can now use a free tool called buildyourstore.ai to launch a fully automated store that would normally cost $200 to $300 to set up. But this does it for free in a matter of minutes. You just enter your name and email, pick a niche like fashion, tech or pets, and the AI chooses winning products, designs your store, and makes it look professional from day one. If you want to go through this process completely for free, then just click the link in the description and it'll walk you through everything. From there, it syncs directly with Shopify, giving you exclusive access to a 3-month Shopify trial for only $1 per month. But what about making sales? Well, the biggest mistake people make with e-commerce is giving up too soon. Surprise, surprise. This is probably because they don't want to deal with inventory or fulfillment. That's why the free AI store builder also walks you through how to integrate a tool called AutoDS, which is kind of like the autopilot system on a plane. It imports trending products, updates pricing and images, and even ships orders directly to your customers. This means you don't have to touch inventory, package anything, or deal with supplier negotiations. You focus on driving traffic and making sales while the system handles the rest. Full disclosure, AutoDS are long-term supporters of this channel, but even if they weren't sponsoring this portion of the video, I'd still recommend them. You can easily create a buzz around your products by creating videos about them on TikTok for free. If you get 100k views and just 1% of the people go and buy your product for $10, then that's $10,000 in revenue. So if you're serious about breaking out of the failing side hustle trap, then choosing a simple automated model like this gives you the best chance at success. No more bouncing between business ideas, just commit, launch, and put in the work to scale it up. Stage 3 is running a successful side hustle. Believe it or not, only 16% of people who start making money online ever make more than $50 per month. The people in this percentile make anywhere from $51 on the low end all the way up to $10,000 a month. Of course, the higher end is what I'd consider actually successful. So what are these 16% of people doing differently, and how can you start applying it to yourself? Well, there's some clear things that I've noticed that separate the people who struggle from those who actually make money online. And to help you get there, I'm going to break them down into 4 key steps that you can follow. Step 1 is to stop trying to appeal to everyone. You might think casting a wide net will get you more sales, but in reality, it does the opposite. If you try to appeal to everyone, you'll appeal to no one. So before you even start promoting your store, grab a notepad or open your notes app and describe so you can get financially ahead. And if you're older, then use this as a checklist to make sure you're on track. I promise, if you just implement a few of these things, you'll be so far ahead of everyone else, they won't even believe you. I managed to become a millionaire in my 20s. However, if I watched a video like this when I was younger, then I'm sure I could have made my first million much faster. Don't just watch the part of the video that's for your age. You need to do all of these things. And if you skip steps, you might end up regretting it. Right, let's kick this off with age 13. When it comes to investing, the hands down most important thing is time in the market. But what does that actually mean? Well, put simply, you want to have your money invested for as long as possible so it can start growing rapidly, like a snowball rolling down a hill and eventually turning into an avalanche. So if you're actually 13 or younger and you're watching this video right now, I think all us oldies would agree that you're in the best possible position. So how do you actually start investing at this age? Well, as you're currently not of legal age to invest on your own, you're going to need to convince a parent or guardian to open up something called a custodial account. Now, I understand it might be hard to speak to your parents about money and investing. My parents never ever spoke about money at all, let alone investing. So if you want to, feel free to show them the next 30 seconds of this video so I can help persuade them to open up one for you. A custodial account is an investing account controlled by an adult for the benefit of a minor, typically a family member. These have different names depending on where you live. In the UK, we have something called a Junior Stocks and Shares ISA, which lets your parent or guardian invest up to £9,000 a year on your behalf. Now, of course, they don't have to do this much, but just think, every birthday or Christmas, you could ask them to put some money into the account and invest in some stocks and shares. I'm not a financial advisor, and this shouldn't be taken as financial advice. However, over the years, I've just invested in a simple low-cost S&P 500 index fund. This invests your money across just over 500 of the biggest public companies in the USA, so you don't have to worry about picking individual stocks. The historical average yearly return of the S&P 500 is 12.58% over the last 10 years, as of the end of May 2024. Of course, investments can go down as well as up. If you've got a Junior Stocks and Shares ISA, then you'll be able to start managing it for yourself from the age of 16, and you could start to withdraw money from the age of 18 if you wanted to. But if you're anything like me, once you've got the investing bug, you'll probably want to keep it growing. In America, you have 2 main options, a UGMA and a UTMA. These both have unlimited contributions, but you could trigger gift tax if your parent or guardian puts in more than $18,000 in 1 year. The only real difference between these two is that with a UTMA, you can also invest in real estate and fine art. A custodial account can be set up with most banks and brokerages. My favourite is Vanguard for both the UK and the USA, as they've pretty low fees and they've certainly been around for a long time. So if you're younger than 18, then please promise me you talk to your parents about getting one of these accounts, as it gives you such a head start. Right, moving on to age 14. Besides time, another huge advantage you have at this age is that you probably don't have to pay rent and other monthly bills. This means you have the freedom to try different ways to make money, since you don't need a reliable income every single month. You should go out and try everything from cleaning driveways with pressure washers to competitive sports. Not everything has to be about making money. You can learn a lot from other activities which you can use to make money when you're older. My son Curtis used to get up at 4 a.m. most mornings for swimming practice. Of course, he didn't earn any money from this, but it did teach him discipline. So when he started his business at 18, he could outwork his competition. I speak to so many teenagers who tell me they don't have a talent. But when I ask them what their hobbies are, they can't even name a few they've tried. You can't expect to find your talent if you don't try a wide range of different things. If it doesn't work out then, that's absolutely fine. Just try the next thing and the next. When you find something you're naturally good at or enjoy getting better at, double down on it and make it your mission to become one of the best. Next, age 15. One of the things I miss most about being younger is birthday and Christmas presents. Not that I got a lot, as my parents weren't very wealthy, but I definitely got more than I do now. That's just the reality of growing up, especially for young men. So instead of asking for presents like PS4 games and other things that you're not really going to care about in less than a few months, a huge life hack is to ask for cash whenever possible. I'd also highly recommend going and getting a Saturday job. Now, don't be too picky at this stage. Even working in a retail store behind a counter can earn you a nice bit of extra money. You'll also learn a lot of useful social skills that will prepare you for the real world. Doing both of these things will help you start stashing away cash as long as you avoid the temptation to spend it. I like to use the word stash instead of save, as I have a problem with the way most teenagers approach saving money. They will save for months and then go and spend it all on a new game console or a day at the theme park. Now, obviously we all like a roller coaster, that's for sure. This shouldn't be what you're stashing your cash for though. Of course, you should spend some of it to have fun. However, see your stash more like a launch pad that you can use to make even more money. The hardest thing in the world is starting with $0 to your name. So if you can avoid that, even if you have as little as $100, then it's going to make everything so much easier. Oh, and I almost forgot. Go and apply for your provisional driving licence. In the UK, you can do this when you're 15 years and 9 months old, so it's worth getting, even if you don't intend to start using it right away. Right, now it's getting serious. Age 16. You've got a 2-year window before you enter the real world, so it's time to really think about what skills you're going to start focusing on and developing. By now, if you've done all the things I've mentioned in this video, then you should have a pretty solid idea of what you're good at. These may seem unrelated at first, but pick a handful of them and start stacking your skills on top of each other. When I was younger, I was talented at selling, designing mechanics and woodwork. So I invested my money into different things that would help me get better at those skills. Now, I had no idea how I'd link them together, but I trusted that in the end, it would all make sense. I'm not really talking about buying courses, as there's so many fake gurus out there just trying to scam you out of your money. With that said, there are some good ones around as well. Even better though, if you can find some sort of community to join where you can chat and learn, so much the better. However, the majority of your money should be invested in equipment. I remember when my son bought his first iMac for $500 from his uncle. He did this with the money he'd saved from doing part-time jobs. Because that was the biggest purchase he'd ever made at the time, he would sit at that Mac and learn everything about it. This led to him teaching himself how to edit videos and use Photoshop. Investing in tools like this can really open so many doors. Between now and 18, your biggest aim should be to develop these different skills that you can later use to make more money than someone that just decided to play video games. This is because you can come into the real world with some actual value to offer. This heavily cuts down the amount of training a company needs to give you, which takes the burden off them. On to age 17. Now listen to me very carefully. You need to pass your driving test. Yes, I know you probably don't need to drive anywhere at 17, but trust me, the sooner you do this, the better. In some states in the USA, you can do this as early as 16. Remember, you only need to do it once. Not being able to drive is one of the biggest things stopping most people from starting a side hustle. I mean, what if you have the chance to work with a client but they live 30 minutes away and you can't get a lift every week? You'd have to rely on public transport, and we all know how unreliable that is. You'll probably end up getting a bad name for yourself and coming across as unprofessional, leading to that opportunity going out the window. One of my key rules to this day is to be early is to be on time. To be on time is to be late. And to be late, well, that is unacceptable. So if you're watching this now and considering driving lessons, do it. Please don't be that person that regrets not jumping on it sooner. Yes, it might be a bit scary at first. I thought it was really exciting, to be honest, but think about the bigger picture. Once you've learned, you can use some of that money you've been stashing away to buy yourself a cheap starter car, then nothing's holding you back. Now it's time for the big one, age 18. The world really opens up to you once you turn 18. Now you're officially classed as an adult, and there are so many things you can do to get financially ahead. I wish someone had sat me down on my 18th birthday and told me exactly what I needed to do. So that's what I'm going to do for you now. I've made a checklist of 7 things you need to do to set yourself up for success. Even if you're over the age of 18, it's super important you do all of these things sooner rather than later. Let me know in the comments how many you've ticked off. Number 1, open your own bank accounts. Having your own bank accounts that only you have access to is the first logical step you should take once you're over the age of 18. I say accounts because really and truly, you should have 2. The first is a current account, or as the Americans call it, a checking account. This is where your money should flow in and out. For example, let's say you got yourself a job at a coffee shop. The coffee shop pays your wage into your current account, and then you can use that money on whatever you want, really. The second is a high interest savings account. This is where you should start building up an emergency fund of 3 to 6 months of your living expenses, just in case something out of your control happens and your income dries up. It's like when you chug a big pot shield potion on Fortnite, but keep some minis handy. So where should you open up these accounts? Well, you need to be looking for banks that don't charge high fees. I remember I used to get charged for stupid little things all the time. Having these accounts shouldn't cost you money. I also think you should have 2 accounts with different banks, as it makes your savings way less easy to spend. When it's out of sight, it's out of mind. If you're in the UK, then I'd recommend going with a challenger bank like Monzo for your current account. Now, this isn't sponsored, but their app is genuinely very good. For your savings account, Chase is a great option as they're currently offering 4.1% interest on your money, so you'll get paid for just leaving your money in the account. In the USA, I'd recommend looking at Ally Bank or Bank of America because they offer minimal fees and have really strong online banking service. Number 2. Get a credit card. When I was younger, I believed that if you never borrowed, you'd have an amazing credit score. Since you never took out a loan or made any late payments, it makes sense, right? Well, that couldn't be further from the truth. Taking out a credit card when you turn 18 is the perfect tool to build up your credit score. You can do this by using your credit card to pay for the things you would normally pay for in cash, like paying for the gas in your car, for example, and then paying the card off in full every month without fail. Using it this way will ensure that you never get charged any interest at the same time as building up your credit score. A credit score is kind of like your Uber rating, but for money. Banks look at this and then they decide whether or not they're going to give you a loan. And if they do, what interest rate they're going to charge you. Now, lots of people are against the idea of getting a credit card because they're taught from a really young age that debt is bad. I know this because that's exactly what I was taught. My dad would always say, never a lender or a borrower be. This was a saying that originally came from rich people years and years ago to keep the workers down, as they knew by borrowing, the working class could create wealth for themselves. The rich wanted to keep getting richer and keep the poor in their place. If I had a credit card when I was 18, it would have been much easier to get a mortgage sooner and buy my first property. I would have also been able to borrow more money at lower interest rates. Now, that may not sound significant, but over a long period, like a mortgage, this can really add up. Number 3, open an investing account. The key is to open the correct type of account. You'll often hear people throwing around terms like Roth IRA in the USA, stocks and shares ISA in the UK, and TFSA in Canada, and supers in Australia. So if you don't have one of these accounts, then you're missing out, as they allow you to avoid having to pay taxes on your investments, but they do have limits because they're extremely powerful. Nowadays, opening an investing account is very simple, as you can do it all from your mobile phone. A great thing about these investing apps is that it actually gives you the ability to buy fractional shares. So rather than having to pay $220 for an Apple share, you can invest as little as $1. Now, I wish I had this option when I was younger, as it would have allowed me to get in some early experience with investing without having to take any big risks. One of my favourite investing platforms is Trading 212, as they offer fractional shares and also stocks and shares ISAs. Since I was planning to talk about their app anyway, I reached out to them to see if they'd be interested in sponsoring this portion of the video. They agreed and are offering a free stock worth up to £100 to anyone that uses the code Tilbury when they create an account. Plus you can get more free stocks by inviting your friends. Both of you will get a free share as long as they fund their account. If you aren't quite ready to invest for real, one of the really cool things about Trading 212 is they let you practice investing with fake money. You can get familiar with the markets using real data without risking any actual money. So if you're a little uncomfortable with investing or just want to try out some strategies before putting your own money on the line, this is a great way to get started. Also, don't worry if you've already opened an account within the last 10 days. You can still use the promo code Tilbury in the app and receive your free share. So feel free to pause the video right now, get your free stock and then continue watching. Number 4. Carefully consider university. So many teenagers have asked me, is going to university a scam? My answer is always yes and no. On one hand, for some careers, you certainly need to go to university, like doctors, nurses and teachers. There is a direct result from doing university courses like this. You get a degree and the career path opens up to you. These professions play critical roles in our society, directly impacting the way we function. So are absolutely not a scam. I actually think these types of courses should be free and reserved for the people with the best grades and passion for following one of these careers. However, on the other hand, there are a lot of other courses out there that don't open up job opportunities directly. And therefore, why waste your money and more importantly, your time studying at university for something you don't really need? Skilled trades like plumbing, entrepreneurship and tech, well, they don't require a degree. It's more about how good you are at what you do. Your track record and results will speak for itself. I mean, I read through my comments on here and I've seen lots of people claim they've learnt more from me than they did in their business degree. Now, that really says a lot. For me, and for a lot of other employers, it's more about your practical experience and attitude than anything else. So please, don't be pressured into going to university to study something you don't care about and waste 4 years of your life. I mean, I heard there's a golf management degree now. How ridiculous. Every time there's a global crisis, most people panic. They're all over the place. Smart people take advantage of the situation. That's why these strategies will work whenever there is fear and panic around. So today I'm going to be running through how you can make millions from the coronavirus market crash and any recession causing crisis in the future. By having the right finances in place, I was able to ride out the last 2 recessions and grow my business back to full strength in an incredibly short amount of time. Before implementing anything, make sure to speak to a financial advisor about your individual situations. Let's first break down what a market crash is and why it's happening. Our economy has seen incredible growth over the last decade. It's been up, but now recently it's come to an end and it's started to crash. Now, when companies are making more money, it of course creates more demand for jobs. And when more people have jobs, they earn more money. Now, this chain of events is extremely delicate. If just one link breaks, such as people not spending money, then the whole system, it just collapses around us. We are currently seeing a chain of events break down on a huge scale, partly because of the virus, but mainly because of the mass fear caused by the media. It's not the end of the world, like the media would like you to believe. Their main aim is to get more people watching and reading the news, as they can make more money from advertising revenue that they depend on. On top of this, there are huge disruption problems to supply chains, especially people like Apple and Amazon who depend on all of these items coming from China. It causes a trickle-down effect. This is why you may have seen bare shelves in the shop and people even fighting over toilet rolls. Who would have ever thought that? Lots of investors see this unfolding and start to panic. They sell off stocks and shares. Now, the biggest takeaway from this is that fear is the number one enemy of the stock market. But you know what? It could be your number one friend. In situations like these, you have to adapt, just like a virus. Look for the opportunity and don't become paralyzed or overanalyze everything. Be smart and take action. Even if it's not perfect, just take that action. Without any further ado, let's jump in. Number one, reduce your spending and build a safety fund. Be unbelievably stingy. Put it all towards building a safety fund. If you don't already have one, it's the most important thing you need to do. This safety fund should consist of 3 to 5 months of your living expenses and only used in an absolute emergency. Now, this safety fund is like your protective shield. You can hold it up, hold it against everything. It's going to protect you against unexpectedly getting fired or if you have a slow month with your own business. But most importantly, fear won't affect you in the same way. Number two, index funds. Now you have your safety fund, you can afford to invest the extra money that you have coming in into an index fund. These funds are one of the safest long-term investment strategies you can take advantage of. Now, index funds are comprised of lots of different companies, therefore they can go up or down with the market. Because people are currently scared, the market has dropped in value dramatically. Now, my prediction is the market will be worth a lot more money in a year from now. If things start to improve with the current situation and people start getting better, then it will kickstart the chain of events and the market will bounce back dramatically. I wouldn't recommend this strategy to anyone that isn't prepared to invest for at least 5 years. Now, one of the most popular index funds is called the S&P 500. This is comprised of the biggest 500 companies in the USA, such as Apple and Amazon and Microsoft. Now, the amazing thing is that buying and holding this fund for a 20-year period has never lost anyone any money. Just let that sink in. Over a 20-year period, it has never produced a negative result. So come on, Mark, I hear you say, how do I get started? Now, I love using Vanguard index funds. You can just jump in their website, it's really easy, open an account, you can pick your own risk tolerance. Now, a general rule here is the older you are, the less risk you should take. Don't be put off by the complicated words. Do some extra research around what funds are best for you and start investing consistently each month, the same amount, just keep investing. If you can make it automated, then even better. Like the saying says, the best time to plant a tree was last year, but the second best is to do it today and get going. The main thing to remember is don't panic when your investment goes down. Don't even look at it, because if you leave it there for long enough, you're going to make a...
I'd say this kind of thinking has led to schools giving out awards for just taking part. But I've got news for you. In life, you only get rewarded if you put in the hard work. And whether you like it or not, we're all in a massive competition. So if you aren't interested in playing, go and watch a Mr. Beast video instead. Age 18 to 24 years old. According to the survey of consumer finance conducted by the Federal Reserve, the average net worth of 18 to 24 year olds is approximately $28,707. However, this figure is heavily skewed upwards, as the top 10% hold 70% of the wealth and the top 50% hold 98%. In fact, the median net worth of 18 to 24 year olds is only about $8,216. For the purpose of this video, we'll define rich as having a net worth 20% higher than the average. Therefore, if you want to be considered rich in this age bracket, you need a net worth of $34,448 or more. This doesn't mean that you need to have this amount of money sitting in your bank account. Instead, it comes from adding up all of your assets and taking away your liabilities. liabilities. So here are some targets I think you should hit if you're serious about reaching this figure. First, you should create an emergency fund. Life is full of unexpected surprises. I know in my late teens my car engine exploded, which was a nightmare. That's why it's important to have 3 to 6 months worth of spending saved up in an emergency fund. This will give you a bit of peace of mind and a financial safety net in case you ever need it. Second, try to avoid bad debt. Of course, I understand student loans can sometimes be necessary if the job you're pursuing requires a degree, so this all depends on your individual circumstances. Third, get a credit card. A credit card can be a great tool for building your credit score and avoiding high interest rates, but it can also be a dangerous trap. Use it responsibly by paying off the balance in full each month. Fourth, invest in yourself. Your human capital is your greatest asset. Invest in yourself by developing your skills and knowledge. This will increase your earning potential, make you far more desirable in the workforce, and give you a better chance at success if you decide to start your own business. And fifth, learn about the stock market. The stock market can seem intimidating, but it's actually a great way to build wealth over time. Open a brokerage account and start learning about investing. Many brokerage firms offer free stocks to new customers. The best I've found is Moomoo, who are giving away 15 free stocks, each worth between $3,000 and $2,000. So take advantage of these offers to start building your portfolio. I'll leave some links down below where you can pick some up, depending on where you are in the world. So overall, I'd rate this a 3 out of 5 on the difficulty scale. At this point, it's all about setting a great foundation for your life. I honestly feel that great financial habits are made during this age bracket. If you haven't done these things yet, then it's not too late, but it can be harder to get back on track. 25 to 29-year-olds. If we go back to the same study by the Federal Reserve, the average net worth of a 25 to 29-year-old is $49,388, and the median is even further behind at $7,512. This median net worth is actually lower than in the last age bracket. This could be due to many early 20-year-olds not understanding their finances and managing them correctly, causing the gap between the rich and the poor to grow. If you want to be considered rich between 25 and 29 years old, then you need to have a net worth of $59,265 or over by hitting the following milestones. First, save up 1 year's worth of your spending. This should be easy to access in the case of an emergency, but it doesn't have to all be in cash. My son Curtis likes to put some of his money into watches as he can wear them when he wishes. These can easily be sold if he ever needs the cash. Second, if you have any student loans, pay them off. In fact, if you ended up getting into any bad debt, then make sure this is all paid off. This will be a huge weight off your shoulders as these loans just bleed you dry. Third, you should have a credit score of 750 or higher. A good credit score is important for getting approved for loans and credit cards with favourable terms. This is very easy to do over the course of about 3 years if you use your credit card correctly by paying your bills on time and keeping your credit utilisation low. Fourth, you need to start making good money. I don't mind how you do it. It could be from a high paid job, a side hustle or a business. I mean, nowadays it's so easy to set up a simple website and start making passive income online. Hosting are great and give you everything you need for under $3 per month. You can even get a free domain with their annual plans. I'll leave a link below with a 10% discount. Fifth, you should be investing 10 to 15% of your income. This could be in absolutely anything, such as stocks, real estate, watches, businesses, or dare I say it, crypto. You just have to pick the area you understand the most and run with it. Early on, don't try to be too diversified. While you're young, you can afford to take more risk. So find your specific area of interest and learn as much as you can about it. Sixth, you should be completely financially independent from your parents. I'm a big believer in staying at home for as long as you can. But you can only do this for so long. So overall, I'll rate this a 5 out of 5 on a difficulty scale. At this point, it's all about increasing your income and taking a few risks. This can be hard for a lot of people to do. They're either too shy to ask for a raise or start their own business, but this is the time to do it. The fatal error people make is they're focusing too much on saving and not enough on earning. I mean, you can save your way to being rich on a low wage, but you won't get there very fast. 30-year-olds. According to the study, the average net worth of 30-year-olds is $198,406 and the median is $45,315. This is when things really start ramping up. So if we use the 20% rule, then if you want to be rich, you should be aiming for a net worth of $238,087 or more. I know this sounds like quite a lot. However, if you can just focus on hitting these milestones, then it should take care of itself. First, save up 4 years worth of your spending. As I said before, this doesn't have to be all held in cash. To be honest, this would be a bit silly. You want it invested in liquid assets. Second, consider buying a house for yourself. There are 40 money-making books that have really stuck with me. So in this video, I'm going to condense all of these books into the core lessons that will actually make you rich. And no, I'm not just saying this. I have experience doing it. I've gone from absolute zero to making tens of millions, and I didn't make my money on YouTube like most people on here. I did it running real businesses. So I promise that the things I'm going to share with you today will take you from $0 to $100,000, $100,000 to $1 million, and $1 million to $10 million if you apply them correctly. Level 1, going from $0 to $100,000. First, you need to master your mind. I didn't come from a wealthy background, and during my youth, I vividly remember people saying the phrase, money is the root of all evil. Secrets of the Millionaire Mind explains how these phrases program us to believe that rich people are the devil. It took me a long time to rid myself of the negative feeling in my stomach when I thought about making money. If I'd have read this book sooner, it would have helped me realise this issue earlier. Once I got over this hurdle, I had to ask myself, what is money actually for? For me, the answer was freedom. The psychology of money puts it a little differently and says it's all about control, but I suppose the goal is the same, to be able to do whatever you want, whenever you want. It also touches on how there's a clear difference between the rich and the wealthy. Wealth is what you don't see. The car's not purchased, diamonds not bought, renovations postponed, clothes forgone, and first class upgrades declined. Unfortunately, many people don't even believe that they can become wealthy. I remember my school friends saying things like, I hope I can get an okay job when I graduate. They weren't even hoping for a good one. The magic of thinking big explains that people are setting their finish line too soon and therefore never have a shot at being successful. While I don't believe that thinking big alone will make you successful, it's certainly the first step. I always struggled in school and felt like a failure. Interestingly, when I left and started working in the real world, I found that I kept winning. This was probably because I chose jobs I had an interest in rather than learning things I didn't care about at school. The Winner Effect talks about actual studies to back up this phenomenon. The book discusses how positive correlation has been found between successful stock market traders and their testosterone levels. Furthermore, winning increases the testosterone receptors in your brain, which causes you to win more in the future. That's why it's important to set those achievable goals and get those little wins every day. I believe that my struggles in school and my strong drive for success had a positive impact on my life. They left me with no other option but to push forward. Think and Grow Rich tells the story about a great commander. Despite being outnumbered by a far superior enemy, he burned his army's own ships, leaving them with no escape plan. This forced his soldiers to fight with everything they had, resulting in a miraculous victory against all the odds. It just shows there's a big difference between wanting to succeed and needing to. Being comfortable is just as harmful as having an escape plan. During a chat with Andrew Tate, he referred to this as one of the Matrix's tools. Unscripted also presents this idea. The author argues that society aims to transform us into model citizens, which stands for mediocre, obedient, dependent, entertained and lifeless. Avoiding this fate depends on how well you can manage stress. The essence of success gives us a helpful perspective on this. The book mentions that all the water that forms a fog that's 100 feet deep and 7 city blocks wide can fit into a small glass. Whenever I feel stressed, I like to imagine drinking this water and using it as fuel. Now you can develop great habits. Stress can also come from factors outside our control. For this reason, I've made a conscious effort throughout my life to only focus on things that I can directly impact. Atomic Habits reveals that many people fixate on the end goal, which they have no control over, rather than the process of achieving it, which is completely in their hands. I found the author's habit stacking technique to be particularly helpful for forming new habits. It involves pairing a new habit with an existing one, so both are completed at the same time. However, most people just keep putting things off and never form good habits. I know far too many people who just go through the motions without any direction, and before they know it, time has run out. The 7 Habits of Highly Effective People stresses the importance of always knowing where you're going and thinking about how you want to be remembered. I know this provides me with extra motivation, but this is only one part of the equation. The 12-week year suggests treating a year as 12 weeks to create a sense of urgency. This really hit home for me, as I know I work best under pressure. Although short-term pain is often necessary for long-term gain, it can be difficult to remember this when faced with challenges. The art of getting things done emphasizes the importance of not relying on your brain to remember all your tasks. Instead, capture them on a phone or a notepad. This way you can organize your tasks without getting them confused, and you can also be selective with how you spend your time. Essentialism reminds us that for every task we say yes to, we have to say no to many others. Therefore, it's important to value yes and not be afraid to say no. After adopting these habits, you should start building high value skills. I've previously said that I don't like the advice, follow your passion. However, So Good They Can't Ignore You takes it one step further. The author interviewed many people who loved their jobs. He found that most of them didn't initially have a passion for their work. Rather, as they improved, their love for their work grew. So what skills should you start building if you aren't necessarily following your passion? The Unfair Advantage suggests that to succeed in an unfair world, you need to play to your natural strengths. Find what you're better at than most people and lean into it. However, it's no longer enough to just possess high value skills. Artificial intelligence is rapidly replacing many jobs. I'm using it more and more in my various businesses to complete simple tasks. That's why the ideas shared in Mastery are more important than ever. My main takeaway was that you need to develop a unique stack of skills that is nearly impossible to replicate. Still Like an Artist echoes this point when it suggests to copy from multiple inspirations until you have a mix that is truly original. Having this unique skill stack will give you the ability to earn a high income. However, that still won't mean you can build wealth without understanding the basics of personal finance. When I was younger, I had a mentor named Dave who taught me about how the rich manage their money. The biggest lesson I learned, which is also shared in Rich Dad, Poor Dad, is that everything we buy is either an asset or a liability. To figure out which one it is, we simply have to ask ourselves, is it putting money in our pocket or taking it away? Of course, if you want to be wealthy, the aim should be to buy as many assets as possible, but lots of people don't see the value of investing. Let me ask you this, would you rather have $3 million now or a penny that doubles every day for 31 days? The correct answer is the penny, because it actually turns into $10.7 million. The compound effect uses this analogy to demonstrate the power of investing and gaining compound interest. Once most people get their head around this, they get very excited but end up jumping into the markets without really understanding anything. That's what happened in the pandemic. Everyone thought they knew what they were doing, but it was just a massive bubble waiting to burst. That's why I've always followed the principles laid out in the little book of common sense investing. It states that trying to beat the market is a losing game. Instead, you should own the entire market. You can do this by investing in something like the S&P 500 or a broad market index fund. Interestingly, over a 35-year period, only 1% of mutual funds could beat the market by 2%. This means that index funds are a clear choice for the average investor. Although, as I do find them pretty boring, I also like to invest in more interesting stocks with a smaller part of my money. Whenever I do this, I keep in mind that the market is irrational. As the intelligent investor puts it, you should imagine a person coming to your door every day called Mr. Market. One day he may offer you $2,000 for your stock, and the next only $500, even though the company may be doing better than ever. This is because the price of the stock is based on demand and not the actual real world value. I only buy stocks if I'm prepared to ignore what Mr. Market says for a long time. Another phrase I live by is, if you love the store, chances are you'll love the stock, which was shared in One Up on Wall Street. This means if you've got a lot of experience of a company or product, you might actually have a bigger advantage than the pros when it comes to investing. Before we get to the next level, I have to make one thing clear. Reading books on investing can provide you with theoretical knowledge, but to truly succeed in investing and build wealth, you need to put that knowledge into practice. So if you are going to invest, you need to make sure that you're using a tool that provides you with all the necessary information to make informed decisions. This is where today's sponsor Moomoo comes in. If you're interested in building wealth, then you're really going to want to listen to this. It's a powerful investing platform founded in Silicon Valley with over 20 million users worldwide. You can trade stocks straight from your laptop, iPad or smartphone, whether in the United States, Australia or Singapore. You also don't have to worry about commission fees and account minimums. I personally really like the free tool they offer, which allows you to see what famous institutions are investing in and what sectors are performing best. As a beginner, you can also practice your trading ideas with a demo account before entering the market. If you sign up today using the link in the description, you can receive up to 15 free stocks, each worth between $3,000 and $2,000. That's an amazing deal. These free stocks can help you start building your investment portfolio right away. Level 2. $100,000 to $1 million. Now that you've fixed all your internal beliefs, to make the next leap, you'll need to know how to generate more value than you can from just selling your time. We're taught to go to school, get good grades, and then get a high-paying job. However, when you do this, your earning ability is capped. Cashflow Quadrant outlines 4 distinct ways to earn money. E for employee, S for self-employed, B for business owner, and I for investor. Business owners and investors have the advantage of using other people's time and money to build their wealth. That's why it's crucial to move to the right side of the quadrant if you want to become rich. But what does it really mean to be rich? Well, the 4-hour work week explains this best when it says that relative income trumps absolute income. To understand this statement, let me ask you a question. An investment banker earns $500,000 per year working 80 hours a week. On the other hand, an e-commerce entrepreneur earns $40,000 per year but only works 4 hours per week. Who's richer? If we look solely at absolute income, then the banker is clearly making more money. However, if we consider the time worked, the banker earns $120 per hour, whereas the entrepreneur earns $200 per hour. To take it one step further, the entrepreneur can actually already live the retired life that the banker dreams of, as he can operate from anywhere in the world. I'll take the entrepreneur route any day of the week. 0 to 1 states that the first step to starting a business is betting on a contrarian truth. This is the basis for most successful businesses. For example, Netflix had to bet on the fact that people wanted to binge watch TV shows at home, and Airbnb had to believe that people would be willing to stay in a stranger's house. For many people, the biggest hurdle is coming up with an idea. However, this is often easier than you might think. Disrupt You outlines an effective method, which is to write down 3 things that annoy you every day and think about how they could be done better. By doing this, you'll have 90 ideas to consider each month. When you have an idea, don't be afraid to share it with people that can help you. People tend to be too protective of their plans, but the truth is that an idea alone is usually not that great. The lean startup emphasizes the importance of execution and the use of the build, measure, learn feedback loop. This approach ensures that you don't create something nobody wants and allows you to pivot and adapt your idea as you go. There was an interesting study conducted on 108 new businesses across 30 industries. Out of these,
92 businesses chose to enter red oceans, while 16 adopted a blue ocean strategy. A blue ocean refers to a market that has little to no competition, while a red ocean is named so because of the fierce competitions between competitors. The study found that 39% of profits came from businesses in competitive markets, while 61% of profits came from those that used the blue ocean strategy. Furthermore, these businesses went on to dominate their industries for 10 to 15 years after launch. A good strategy for creating your own blue ocean is to become oversubscribed. Consider Ferraris. Many people want them, but not everyone can have one. Yet the people that run Ferrari aren't losing sleep over this, as they know that this scarcity keeps demand high and the cars highly desired. Every oversubscribed product has people who are willing to buy it but can't get their hands on it. When I'm driving up demand for my products, I always remember the core lesson from Breakthrough Advertising. This book is actually the most expensive book in the video. It states that you can't manufacture desires. Instead, your job is to create a product that fulfills